at those. And it's important right now to establish the potential returns you can make in stock investing. And it all comes down to the expression beating the market. I'm sure you've heard this expression. Maybe someone, at work says, "Oh, I beat the market. My portfolio beat the market this year." Or, maybe you're reading in the media and you read in the media, most hedge funds this year didn't beat the market. So what are they talking about? What does that mean? How is the market even measured? How do you measure the stock market? Well, the stock market is commonly measured by a few popular stock indexes. Now, what is a stock index? A stock index, simply put, it's a group of stocks that are bunched together based on certain criteria. And what they do, they serve as a benchmark to measure the overall market. So we're talking sometimes 30 stocks are in an index, sometimes 500 stocks are in an index, sometimes 2,000 stocks are in an index. So let's jump right into a popular stock index, the Dow Jones Industrial Average. And if you want to pull up the Dow Jones Industrial Average on a chart, what you do, you punch in the money sign and then you punch in INDU, or maybe you just have to punch in INDU, and it will pull up the Dow Jones Industrial Average on a stock chart platform. So whether you're using Google Finance, Yahoo Finance, stockcharts.com, you have a platform, something that's giving you a stock chart, you'll be able to pull up the Dow Jones, and you can specify the timeline you want to look at. So what is the Dow Jones Industrial Average? Now, you may be thinking it's just manufacturing stocks. That's what I used to think when I first started. But it's not just industrial. The way I would describe it, it's 30 major American companies in a variety of industries. I would say it's kind of the industry leaders of each industry. And I would recommend, if you don't know what 30 stocks are in the Dow Jones Industrial Average, go look it up. That's a piece of homework right away. Again, you're in the introduction, you think it's going to be easy. No, we're going fast and we're going hard, because that's how you're going to learn. You're going to learn by, again, understanding what I'm talking about, but then going a little bit above and beyond and doing the homework pieces. Again, there's not going to be too much homework, but the more effort you put into this course, the more effort you're going to get out of this course. So if you don't know what the Dow Jones Industrial Average is, go look it up. There's 30 stocks. You'll likely know most of the stocks in the Dow Jones Industrial Average. Now, maybe you've heard of the NASDAQ. Now, don't be confused here. The NASDAQ is a stock exchange, but the NASDAQ Composite is a stock index. So what it is, it's a weighted index of all the stocks that trade on the NASDAQ exchange. So when the news says the NASDAQ was down 2% today, you know that most of the stocks trading on the NASDAQ lost value today. So you can quickly get a feel for the overall market just by taking a look at the NASDAQ Composite. Same thing with the Russell 2000. Now, the Russell 2000 you might not have heard of, but what it is, it's talking about the small companies. We call those small cap companies. The cap stands for market capitalization, and we'll have a whole module dedicated to market capitalization. So don't stress about not knowing what that is. And you've likely heard of the S&P 500, stands for the Standard & Poor's 500. You've likely heard of that. Maybe you've heard on the news, oh, S&P 500 up 2% today or up 1% today. You know the market as a whole was up today. And the S&P 500 is the most popular stock index because it represents the 500 largest stocks that trade on the major American exchanges. So that's the New York Stock Exchange and it's the NASDAQ Stock Exchange. And when we say beating the market, we really haven't answered the question, what does it mean to beat the market? It means to beat the stock indexes. So since the S&P 500 is the most popular stock index, let's take a look at the S&P 500 index performance. So we're looking at 20 years, 1995, 2014. So 1995, 34% increase in the index. 96, 20% increase in the index. 97, 31% increase in the index, 98, 26%. So we can see all these stocks are going up in the late 90s. What was going on in the late 90s? Well, if you recall, the internet was getting big in the late 90s, and there was these internet companies that were coming up, Yahoo, eBay, Microsoft. All of these companies were really gaining some ground because the internet was new. No one really knew how to measure these internet companies because the internet as a business marketplace, how can it be measured? How can we know how big these internet companies? It seems like these internet companies can keep getting bigger and bigger and bigger. And the prices increased. It's never before have we seen such a bull market. So what's a bull market? Bull market's when the everything's going up and the indexes are really going up. And what this created was a lot of investors buying into these internet companies. And these internet companies kept going higher and higher and higher, unsustainably high. It created a bubble. And we see in 2000, we have a crash. We have what's known as the dot-com crash, and we go into what's known as a bear market the next couple of years. Now, a bear market, again, the opposite of a bull market. It means most stocks are declining in value. So bull market, maybe you've heard that term before, it means everything's going up as a whole. The bear market means everything's going down. It's usually related to the indexes again. So the indexes are a great place to start with learning how the stock market works. Again, if you want to learn how the market's been doing, just go look up the S&P 500. Google Finance charts, Yahoo Finance charts, stockcharts.com. Again, you can get free charts there. You can get a subscription to get bigger charts kind of thing. So you can do a lot for free on the internet. But continuing on, we can see we're back into that bull market. The mid-2000s, very prosperous times. I'm going to hold back here because remember what happened in 2008. 2008, we had the biggest stock market recession occur since the Great Depression. Negative 38.49%. That's a massive decline. And we haven't seen a decline like that since the Great Depression back in the 30s. So that's why it was such a big deal with the recession and the financial crisis in 2008. Stocks really lost a lot of value, almost 40% of their value, which is huge. A lot of people lost jobs. A couple major banks went bankrupt. Again, the real estate market crashed. It was quite the economic disaster that occurred. But sure enough, the market recovered. 2009, 2010, 2011. 2011's flat. 2011 they were worried about maybe a double dip recession, but it didn't happen. Just a flat market for 2011. But as we can see, 2013, 2014, we're back in the bull market. And you'll hear the media talk about, are we going to crash? Are we going to go into a bear market? But the media will again, they'll worry for you. They'll always be talking about, is this bull market too long? Are we, again, going to go into another bear market? So let's keep going here. And it's important to realize that over the last 20 years, the annualized return would be 11.92%. And what that means, it comes back to answering our questions, is how is your portfolio performing relative to the major stock indexes? So in 2014, was your portfolio greater than 12% return? And on average, has your stock portfolio returned more than 12% per year? And maybe your stock portfolio hasn't, or maybe the investment hasn't. So if the investment return is under the major index, it's considered to be not beating the market. If your portfolio return is over the stock market index, such as the S&P 500, it's considered to be beating the stock market. But it's not really important whether you beat the stock market or not, but what is important to manage is expectations. The idea here is you can make great returns, like you can make 20%, 30% in a year in the good years, but then think of the bear market. See, everything's down. You really want to minimize losses or prevent any losses in the down times. So the stock market has swings, and that's why people talk about timing. And there's so much to learn with the stock market, but if you study the stock market indexes and you know all the stock market indexes, that's really a great starting point.